Good morning, good afternoon, good evening, and welcome to the 7th episode of Insights on Digital Financial Services during COVID-19 webinar series organized by the ITU. We hope that you, your family, your friends, and your colleagues are all keeping healthy and safe. My name is Bilal Jamoussi. I'm the Chief of the Study Group Department at the ITU Standardization Bureau in Geneva. And it's a privilege for me to introduce today's webinar on digital currency applications and the need for standards. This episode is the second part of the episodes on digital currency. In the first webinar on digital currency on Friday, 26th of June, we discussed the different types of digital currency, including central bank digital currency, and the impact it could have on financial inclusion in emerging economies. Before I introduce the panelists, I would like to provide some general information concerning the logistics of today's webinar. We have many participants joining, about 100 or so at the moment, and many more will be joining us as we ramp up. All the presentations will be available on the webinar website. I'm pleased to inform you that we have closed captioning in French for the webinar today. All questions from participants will be taken at the end of all presentations during the Q&A session. Participants can submit their questions by typing it in the Q&A window in the middle bottom part of the screen. When submitting a question through the Q&A window, I invite participants to type first the name of the panelist to whom the question is addressed, followed by the question. If the question is addressed to all the panelists, simply type directly your question. The webinar is being recorded, and the recording will be made available on the webinar webpage later this week. I would like to now introduce our speakers, Mr. Dinesh Shah from the Bank of Canada, Mr. Lawrence Rufrano, Stanford University, Todd McDonald, R3, Ezekiel Kopik, Silo, Jacques Franckneur, Security Inclusion Now. They will be coming on board and presenting in a moment. But first, allow me to do a quick introduction, setting up of the panel. Payment systems and more fundamentally, money are evolving rapidly. Deployments in digital networks and information technology and the increasing share of internet-based retailing have created a demand and technological space for peer-to-peer digital transactions that have the potential to radically change payment and financial intermediation systems. Central banks have been pondering whether and how to adapt. One possibility is central bank digital currency, or CBDC, a widely accessible digital form of fiat money that could be legal tender. While several central banks have studied the adoption of CBDC and have undertaken pilots, many have not actively explored it. The ITUT focus group on digital currency, including digital fiat currency, which concluded its work June 2019, brought together the ecosystem stakeholders, central banks, telecom regulators, digital currency platform providers, payment system providers, and international organizations to discuss the various technology options for central bank digital currency design. The focus group developed a reference architecture for the different implementations of central bank digital currency, CBDC, for retail, wholesale, and cross-border payments. According to the focus group research, a number of central and private banks are actively exploring wholesale CBDC and privately issued DFC, digital fiat currency. Wholesale CBDC theoretically facilitate wholesale payment transactions between the national central bank and participant financial institutions. More generally, privately issued wholesale CBDC could facilitate additional functional possibilities for payment systems, such as interoperability of ledgers and capabilities for atomic transaction execution. This could allow smart contracting, choices to market players, opening further possibilities for programming the currency. Recent central bank pilot studies indicate that distributed ledger technology, DLT-based systems, provide the possibility of tokenization of both cash and securities on a single shared ledger, resulting in better asset interactions during delivery versus payment, or DVP, settlement relative to current settlement mechanisms. DLT refers to the process and related technologies that enable nodes in a network or arrangements to securely propose, validate, and record state changes or updates to a synchronized ledger that is distributed across the network's nodes. Transactions recording during DLT-based DFC payment systems could be cheaper in aggregate than transactions recorded across multiple siloed accounts, increasing the utility of the wholesale payment system. At least two central banks, Ecuador and Uruguay, are known to have conducted limited scale pilot retail CBDC insurance, and others are researching pilots, example, Bahamas, Eastern Caribbean, Currency Union, Sweden. Some central banks, example, Barbados and Philippines, are supporting private sector digital fiat currency in regulatory sandboxes. Central banks have been exploring various technological solutions and operating models for their retail CBDC, while some central banks have adopted to centrally manage the entire infrastructure, including wallets like e-peso. Others control the issuance while enabling financial institutions to carry out the distribution through API access. Central banks can choose between different technological architectures that are either DLT or non-DLT based. Any DLT-based implementation of CBDC will likely be based on private permissioned networks because they fit best with the need to oversee transactions among network participants and regulate access to the network. Some central banks are considering retail CBDC in the form of a card or a mobile wallet app on which prepaid values are stored locally rather than on a ledger, providing offline capabilities to provide near the same 24/7 availability of cash. The focus group also recommended certain design principles for CBDC. Although the design principles will be specific to the CBDC type, there are several key design principles that are universally applicable to all types. First, the rationale for CBDC issuance should drive the choice of the operating model, architecture, and technology choice. The CBDC architecture should be robust, secure, and aspire to mitigate cybersecurity risks. Any specific design choice should consider the existing IT infrastructure capacity, the legal and regulatory framework, the central bank mandate, and the market environment with a specific focus on the end user and key private sector actors, such as digital financial service providers. Finally, the design of the CBDC should be technology agnostic, and the choice of technology should come at the very last stage of the design process. In today's episode, we will consider the applications of digital currencies and CBDC, the security risks, and the areas where technical standards are needed. Now, ladies and gentlemen, it's time to turn to our speakers. I will now be inviting our speakers in turn to make their presentations. Each speaker has 10 to 15 minutes for a presentation. Our first speaker is Dinesh Shah from the Bank of Canada. Mr. Shah, you have the floor for 15 minutes, please.
Thank you, Bilal. And many thanks to you and the organizers for this very kind invitation to this very interesting discussion. Let me just get my slides up here. Okay, so I trust these are visible to everyone. So now the Bank of Canada is maybe better publicly known amongst this audience here for its work on a series of projects called Jasper. And this is a set of experimental projects really looking at the role that DLT could have a part to play in wholesale interbank payment markets and in securities exchange. So they have applications in securities exchange and cross-border. But this is really concerned with the wholesale side of things. Today, I actually want to speak a little bit about our work on a retail central bank digital currencies, or a general purpose CBDC. And then I will talk about how we see at least some initial thoughts on the place of standards in this work. Okay, so I should start with the usual disclaimer. These opinions expressed here are mine and not necessarily those of the Bank of Canada. Okay. So the Bank of Canada actually has really quite a broad strategy when we think about money and payments. It's not all about simply thinking about CBDC. It's a coherent strategy, if you like. And there are really three elements to it. First of all, especially for those in Canada, you know that there's a large program of work centered around Payments Canada, the institution that really deals with that runs systems around large value payments and retail payments in Canada. And there's a large modernization program going on. The Bank of Canada has a oversight of those systems. And needless to say, we're very, very supportive of that modernization program. At the same time, we also have cash in circulation, still plays a big part in the economy, and we continue to make sure that not only is cash available to whoever wants to use it, but also trying to drive more efficient mechanisms by which we can actually distribute this particular product. Now. We are also, and you'll see this publicly as of February 25th. We're actually in the process of building, planning as a contingency, and I stress that as a contingency, if we need to, the capability to issue a central bank digital currency to the public. This isn't finalized by any means, but we do have the possibility that this could happen in the future. Needless to say, it'll take several years to build such a capability. So rather than wait until the circumstances arise in which we would do this, we need to actually get on with thinking about building a contingency now for it. So we've identified a couple of circumstances in which a central bank, in the Bank of Canada, might issue a CBDC. Underneath these, of course, are a set of complex policy questions as to when and exactly why and in what form we should issue a CBDC. But they're really broadly two. One is that the role of cash continues to decline as a payment means in the economy. So, for example, we might find in the future that more and more retailers stop accepting cash. And the problem with this, of course, is that people won't have the public option to pay with a risk-free instrument, which is what banknotes are, for the transaction that are free of any commercial considerations. So we think there's value in having this a public option. There's access to a risk-free payment instrument. The other option, the other possibility that could arise is that we could see non-Canadian dollar denominated monies, whether they're from the private sector or indeed whether they're from a different nation state, taking a foothold in the Canadian economy. And this raises some really quite difficult problems for a central bank in trying to conduct monetary policy. So we want to retain the Canadian dollar as the preeminent unit of account in the Canadian economy. So we've actually done some work to identify what the sort of core features of a CBDC might be. I won't go through these exhaustively. I encourage you to read some of our work that describes these, and at the end I'll show you the a website where you can actually see more. But I'll touch on a couple of the important ones. So universal accessibility. Banknotes are available to everyone, right? You don't need anything. You don't even need a wallet to carry it in, right? You can just stuff banknotes in your pocket. They're very resilient. Power goes out, cellular network fails, you can still pay with a banknote. Similarly, they're very private. In fact, to the point of really being quite anonymous. In the case of a central bank digital currency, we don't expect outright anonymity to be present, but we do expect very high levels of privacy, and we know that this is something Canadians value. Safety is very important. This is actually a quite a broad topic, but this plays out in when we think about building systems as security, right? We need this to be an extremely secure means of payment, so that consumers can use it with confidence, just as they do our banknotes. The Bank of Canada has a very broad role in promoting the economic well-being of Canadians. And part of that is to make sure that we have a really efficient and competitive payment system. And CBDC may have a role in providing that competition and efficiency. And finally, as I mentioned, we want to make sure that the Canadian dollar remains the prominent unit of account. So CBDC should help in that. Now, before I move on to standards proper, I just want to put out this rather simplified, I grant you, business model. In fact, this is just a very small fraction of the business model. But for our conversation here, I think I just want to set this frame. So very simply, we can think about two different, let's say, distribution models rather than business models. So the central bank could, of course, very directly work with Canadians who wanted. It could set up the entire infrastructure, the distribution mechanisms, and so on. And clearly, that's a lot of work for a central bank, and is something very new. I mean, the way we distribute cash doesn't work like this, for example. It does go through indirect means, as you see on the right there. So we have a set of intermediaries. Right now, these are financial institutions, the large financial institutions in Canada. But in the case of CBDC, these intermediaries could be not only FIs, financial institutions, FIs, but they could be fintechs, right? And maybe other types of business. Now, the central bank has this wholesale relationship with these intermediaries, and the intermediaries are the ones who have this retail relationship with the end users. So the intermediaries are the ones who provide the end user services and products that they use. So how does this play out when we think about standards? So very simply, I mean, a central bank could effectively set in its jurisdiction a set of standards, and you might perhaps consider these more like terms and conditions rather than standards by definition. But there's some reasons, and this is very early thinking right now, why this may not be such a good idea, and why there may well be value in having common standards. So the first thing to note, of course, is that central banks are public institutions, and typically they cooperate far more than they compete. In fact, I would suggest, although I'm not a policymaker, of course, that there's probably more cooperation between central banks than there is competition. And this would perhaps lead almost naturally to a sense that common standards just make a lot of sense in terms of efficiencies around delivering a central bank digital currency for central banks across the world. Perhaps more interestingly, going back to the two distribution models I showed, there's a lot of value because we can imagine that these intermediaries really form a marketplace for central banks. Different intermediaries will think about different ways in which they can distribute. They may look at different market segments, for example. And having a competitive market could really be something of a benefit for the central bank to have a bigger choice, perhaps lower cost of product of high quality. Conversely, assuming that there are many central banks who are going to issue a CBDC, it could be that this also creates a large marketplace for the intermediaries themselves, right? So they have products that could be sold to the Bank of Canada, perhaps, and of course many others around the world. So we have something of a potentially something of a win-win there. There are some. This is more of an open question. There are some features of a central bank digital currency, and we often cite universal access and privacy as two that could really be hard to incentivize for the private sector. And just touching on universal access, in the case of a public policy, we want everyone to be able to have access to a CBDC, and typically in the private sector, it's hard to see that being an incentive that makes sense for, and let's put it very bluntly, for people who won't generate a profit for those private for those private sector intermediaries. So the open question is, do standards have a part to play here in helping get over this this incentive deficit? And lastly here, there is a question around interoperability and whether standards can play a part. Intuitively, it seems that it does make sense, whether this is between CBDCs in different jurisdictions to help with cross-border payments, or indeed with other types of private digital fiat currency. It may well be that there are efficiencies to be gained from having standardization around interoperability. Now, there are clearly some challenges, and I will again stress this is really very early thinking for a central bank. But it's quite clear that there are differences in objectives here. Central banks are public institutions. Third parties, of course, have primarily a profit motive. And I'm not quite sure if this sets up something of a dilemma, because we have both stakeholders at the table when we consider standards. And I also have no doubt this is not new, right? I'm sure this has happened time and time again when we think about other types of standards. Now, standards can, of course, take many years to form, and this is completely understandable, right? There are many stakeholders. It's actually very, very complex. And as I think John Keefe actually noted at the previous talk, John Keefe from the IMF, that there are some central banks who are already somewhat underway with experiments and approved pilots even. And of course, they can't wait for standards to be written, and this is potentially a problem. However, I would perhaps put some sense of perspective around that. In that you could argue that the policy motivations for those central banks to proceed, I think especially financial inclusion and reducing the cost of cash distribution, in a way, the benefits of that could outweigh the costs of having to rework systems later. And I think right now where we are, it's very difficult to see how a central bank at this moment in time could really design systems in a way that makes it much easier to hop onto new standards effectively later, simply because we don't really have a good view of what those standards are. And I think lastly, one obvious problem or challenge is, well, what's the right level of granularity here? What exactly should the focus be on standards? Again, I'm sure this has been discussed many times in various other standards that have been undertaken. Clearly, having too much in the way of standards and having a very locked down way of building systems, considering that these would be multi-decade long systems, is going to perhaps hamper innovation. But if we have too little, of course, then it's practically useless. So that balance, I think, is going to be quite tricky. So those are all the remarks I have. I would encourage anyone who wants to know more about the Bank of Canada's work in this area to have a look at our website. There's quite a rich literature there, both on our retail work and our wholesale work. So if you go to a website and search something like digital currencies or fintech, you'll come across this site. Thank you.
Thank you very much, Dinesh, and thank you for building the case for international standards. I think you call them common standards in in contrast to national standards. And you make the case by saying that central banks collaborate and cooperate more than they compete. So it behooves central banks to have an international standard where the intermediaries could be talking the same language and providing service between central banks. And you also highlight the importance of speed of developing the standard. And hopefully through the work that has been going on in the ecosystem that you mentioned with the focus group and others, we could have the framework for further quick development of an international standard that might be needed for this space. Thank you very much, Dinesh. We'll come back with the questions from the audience in a few moments. Before that, I'd like to invite our next speaker, Mr. Lawrence Rufrano from Stanford University. Lawrence, you have 15 minutes, please.
Oh, thank you. And good morning, everyone. I was a little bit amused because I realized that June is the 75th anniversary of the United Nations, and that the treaty was actually signed where I'm sitting right now, which is in San Francisco. But again, thank you for the opportunity to speak. I'm a member of the Stanford Future of Digital Currency program. One of my colleagues will be speaking later. His name is Jacques Francir, and he's our Chief Technology Officer. I wanted to talk in three basic areas today. First of all, I wanted to talk about some of the fundamental research that we are conducting at Stanford and how that affects CBDC and how it will affect the nature of standards and legislation that will be occurring here in the United States. I also want to talk about the current state of affairs with regard to COVID and how it has affected our thinking about a central bank's digital currency. And I also want to talk a little bit about the problems that we're facing in terms of the way that laws are made in the United States and how they can actually impact the creation of a digital dollar. So just again, by way of background, we have two areas of focus at Stanford within our lab. One of them, which has already been mentioned, is called interoperability, and I will get into some examples of that in a second. And the other one is called zero-proof knowledge, which is an area that has been in existence for quite some time in terms of preserving privacy of data. However, the research around zero knowledge proofs has dramatically increased within the last several years, and probably addresses a lot of the policy issues that are associated with privacy and confidentiality and with the CBDC. But then let me kind of reset and level set for just a second. So at its core, blockchain obviously is a record-keeping system. It can be trusted, and it can be trusted for reliability and accuracy. Again, because we're using a series of computers, or what we call a series of nodes, and different types of methodologies or protocols that ensure that the data that is being stored and also the data that is being recognized is accurate. Thus, there's a dramatic shift here that can occur because we now suddenly have a means of moving to technology rather than and away from our traditional financial institutions, such as banks and such as fiduciaries as custodians, as a new form of a trusted intermediary. The second thing to understand also is that the whole concept of blockchain is based upon mathematics. And math, when proven, is a universal concept. In other words, it has truths in and of itself. And a lot of the blockchain, again, is based on math. And therefore, what we are also creating is a system, again, not only of reliability in terms of our record keeping, but again, for the reasons I've mentioned, we're creating a system that we can rely on heavily as a trusted source of information. Now, let me return a little bit to interoperability and what we're doing at Stanford. I want you to imagine a world in which you could transfer money any place in the world in a matter of seconds, and you could actually use that money to transfer to a friend or a family member, or you could use it to purchase goods and services. There's been various studies done around the world. One study that I'm going to refer to is a study conducted at Goldman Sachs back in 2017, in which the conclusions from the study showed that if money can be transferred on an instantaneous basis, and in addition, the money can be transferred with an invoice attached to it or a smart contract, that we could actually improve the economies around the world substantially. In other words, in the United States or other developed countries, we could increase GDP by approximately 1 or 2%. And in countries that are developing, we could actually improve GDP by as high as 6 or 7%. So the whole idea of international transfer of money is probably is an essential concept. We hear a lot today as we moved into this COVID crisis about I guess stronger borders, stronger nation building. I think that the way that we think about currency at Stanford is more on, again, a universal or worldwide basis, with this whole concept of the ability to transfer money around the world in a very seamless fashion. And again, the benefits are as follows. If you think about the systems we have now, one of them, which is SWIFT. SWIFT is in the process of being modernized, but it's a system that has technology that dates back to the early 20th century. And if you've ever used the SWIFT system, you know that it can take up to sometimes 10 business days to transfer money from one country to another. The money has to go through what is called a correspondent banking system, which is effectively a daisy chain of banks. For example, you could use your local bank to transfer money, which then transfers the money to a money center bank, which then transfer the money across overseas to another country, which may also be a money center bank, and then to a local bank. All of this takes time. It requires reserves or capital on the parts of the banks. It absolutely absorbs critical liquidity for the banks themselves, and there's fees involved. And those fees can be extremely high. Even here in the United States, we have many people that are unbanked who want to transfer money to their let's say to their native country or to their families in their native country, and it can be very costly. In some cases, it can be up to $35. So again, with this whole notion of interoperability, we're talking about is the ability, again, of different blockchain systems, for example, different distributed ledgers, or other forms of technology to talk to one another in a very seamless fashion and in a very efficient fashion, so that, again, money can be transferred around the world very quickly. Again, I bring up this topic because I see this whole idea of interoperability as a form or a force of unification, a force of, at a very grassroots level of bringing individuals together so that they can, transact regardless, again, of their geographic location or regardless of the philosophy of the countries that are involved, where each of the participants in a transaction reside. I want to move on now a little bit to the notion of what's happening in the United States with regard to financial inclusion. And then I want to move on into the whole idea of how potentially a CBDC can help with financial inclusion. Financial inclusion is a problem which is not easily solvable. Many people, and when I first started thinking about CBDC, I thought, well, gosh, this is the panacea. This is the way that we can bring far more people into the banking system. However, like any problem, the problem is multifaceted in nature. And let me go into some of those problems. So right now in the United States, approximately 25% of U.S. households lack a bank account. There are 128 million households in the United States. So it's estimated, based upon recent studies that were conducted about 2 years ago by the FDIC, that approximately 60 million people out of the U.S. population of about 350 million people are unbanked. Okay, now why is this happening? Okay, I mean, here we are with plenty of technology. We have probably about over 5,000 banks in the United States, yet people remain unbanked. The question is a complex one, and it has to be looked at, again, from a multi-dimensional perspective. But here are some of the things that have to be considered. The first thing is behavioral. Okay, Dinesh had mentioned that there's a decline in use of cash. However, cash is still used, and it's still used in the United States. In fact, the United States has probably had a lesser decline in the use of cash compared to other countries. So there are many estimates out there, but approximately 30% of the unbanked choose to be unbanked. They want to use cash, and they want to use it for a variety of reasons. One, maybe is simply because they trust it better. The second reason is they may not trust technology. The third is that they may not want people to know how they are transacting or what they're transacting or why they're transacting. So in other words, there's this idea of privacy. And when we think to the future then in creating a central bank digital currency, again, we have to do it in a way that maintains the current level of privacy that we have now with the use, in this case, of dollars. And I'll get into the idea, again, of zero knowledge proof and how it can help do that. The other thing is that we have a problem here of communication. Not everyone is connected to the internet. And this is also a common problem in other countries, and certainly Dinesh and I have talked about it in terms of Canada. The estimates are unclear, but about 20% of U.S. citizens don't have access because they're in rural areas to the internet. And why not? Well, of course, because it's costly to deliver that service to rural areas where there's not an abundant use of the internet. There's also maybe on the part of the aged an unwillingness, for example, to trust maybe the internet, or also to trust, to mobile banking. There is a strong behavior in the United States of using checks. Within the Midwest, for example, 70% of the businesses pay by check. And you would say, well, why do they do that when they have other means of transferring money in a much more efficient fashion? And this gets back to the idea of habit, and not only habit for small businesses, but also habit for individuals, how they actually behave on a daily basis with the use of money. And again, that is something that has to be considered in the creation of a CBDC. In other words, we need to actually go to where the people are. We need to go to how people behave now before we can expect them to adopt a new form of technology. One good example that I can give you is that there's a company here in the United States called Snapcheck. And the whole idea behind Snapcheck was to simply take a picture of a check and email it to from a payor to a payee. The payee could then download a Snapcheck app and simply deposit the check. Well, believe it or not, it took this company about 3 or 4 years to actually market its product to individuals as well as to small businesses. And yet its product is still in the, I guess, early adoption stages. Again, behavior is something that we have to always consider. Now let's go to the legal issues, which relate again to legislative proposals. It is unclear in the United States what money is. Okay, we have, as you know, in the United States, a U.S. Constitution. The Constitution gives the federal government the power to mint money. However, it never defined money. Okay, and obviously during the 1700s, when the Constitution was passed, there was no real clear idea of what digital could mean. So that's one issue that we have. The second issue that we have is not only what is money, but what are the powers that the U.S. Treasury in the United States has, as well as the powers of the Federal Reserve. Can the Federal Reserve actually create a digital currency? Can the U.S. Treasury actually create a digital currency? Well, again, I want to just emphasize that this answer is not as clear as it may seem to be. So how do we go about kind of developing that answer? This again, I think, goes back to the discussion that Bilal as well as Dinesh has already mentioned. It starts out with the whole concept of policy. And policy is going to be driven by a number of factors. The factors not only include what I've mentioned before, adoption, but it also includes other characteristics that we think a digital dollar should have. In our early discussions with the Federal Reserve, the whole idea is that a digital dollar should actually mimic the characteristics of a physical dollar. So that, for example, that dollar should be able to be transferred from one individual to another. And Bilal talked about this whole idea of atomic swaps, which is one way of, again, transferring money. And then it's transferred in a private manner from one individual to another. So if we begin to think about the functionality of money, and then we can then sit down and start developing a definition. And then who should be in that room in developing the definition? Well, in my personal opinion, and based upon my personal experience, I believe it should be three types of people. The first, it should be lawyers. And the reason why is because lawyers are skilled at the usage of words and the precise usage of words. However, lawyers are not technologists. So we definitely need technologists in the room to have this discussion as well and defining money in terms of its digital form. But again, who would these technologies be? Well, they could be systems engineers. They could also be coders. They could be also potentially, blockchain experts if we're using blockchain, or they could even be electronic type money transfer experts. And the third group that we probably need are economists. In other words, if we create a digital currency, how does it actually change, or could it impact monetary policy, or how money can, in a digital form, impact the economy? So now moving to other issues that we have in the United States, we have the issue of the stable coin, and I'm sure you've all heard about this. Again, a stable coin is simply an instrument which is backed by some other instrument of value, and could be, in this case, dollars. Despite all the discussions, the United States has not actually determined the status of a stable coin. We really have several agencies involved in this discussion, one of them obviously being the U.S. Treasury, the other one being our Securities and Exchange Commission. Interestingly enough, a stable coin almost looks like a mutual fund. So is it a security, or is it actually a currency? Again, that question has yet to be determined. As far as privacy is concerned, let me again mention zero knowledge proof. It is a means by which to prove a fact while at the same time not releasing private information. So to give you an example, if I go to, an establishment, and I don't want to give you the wrong impression, but let's say I go to a bar and I get carded for my age. The establishment could ask if I'm of age to actually enter the institution without revealing through the technology that I've just mentioned my exact date of birth or my exact age. So there are, again, ways of maintaining confidentiality with technology, while at the same time answering the questions that, let's say, a bank would need to know about an individual who is opening a bank account. You know, for example, their address or their social security number. The last thing I just want to talk about is the path forward here in the United States. And I'll finish up. But the path is going to be one which is going to be very indirect. There's been legislation that has been proposed in the last two COVID relief bills for a central bank digital currency. Those pieces of legislation were withdrawn. However, we don't expect any legislation to be passed in the year 2020 simply because we have elections coming up in November. So what is going to happen next year? Well, the likely possibility is that legislation will be passed that will require either Treasury or the central bank to begin studying a central bank digital currency. And studies are actually underway within the Federal Reserve, but they're not actually underway within Treasury, which is very resource constrained at this point. We could also possibly expect requests for a proof of concept. However, that too is unclear. So I would expect that the United States will actually not be a leader, I hate to say this, but I would expect them to be a little bit of a follower in terms of the adoption of a central bank digital currency. And the reason why, again, is because of two reasons. One is that we're very debate-oriented in the United States, and there are very different points of view about new pieces of legislation. The second thing is that in order for legislation to be passed, many times it requires some form of crisis. And right now, we don't see a crisis around the use of a digital, the use or the need for a digital currency. Even though the United States dollar is a reserve currency, it still is not seen as being threatened by other types of digital currencies that are emerging around the world. I'll conclude my remarks right there for now. Thank you.
Thank you. Thank you very much, Larry, for sharing with us the perspective of the CBDC in the United States. We'll come back later on with some more questions for you. Okay. Our next speaker is Mr. McDonald from R3. Todd, you have the floor for 15 minutes, please.
Thank you very much. Thanks for making the time. I apologize, perfect timing from working from home. My neighbor is just about to cut his grass and blow some leaves, so hopefully we'll be okay. Before I get started, just introduce myself from R3, one of the co-founders. Previous to R3, I spent about 15 years in financial markets on the foreign exchange trading side, running FX for the Americas for Standard Chartered Bank. So this topic is near and dear to my heart, being within the currency world for many years and seeing really another side of it in the last 3 to 4 years in the work that we're doing at R3. So for today, I wanted to take a little bit of a different tack here and not just talk specifically about central bank digital currency, although we'll talk about that quite a bit. It's more around digital currency more broadly. What's the context of this evolution? Why now? Why is this topic really moving forward now? And then closing up on some of the requirements that we've seen for implementing digital currency, but talking about that from not just the supply side, which I think we spent a lot of time on, but the demand side. Who's asking for this? Where's the demand and the pull in the market? And talk about potential path forward for standards. For context, very briefly, this is digital currency is not a brand new topic. Obviously, a little over 10 years ago, with the introduction of Bitcoin and cryptocurrencies, it really sort of made this more visceral for folks publicly in the general public, but also specifically within the central bank sector. But it's not cryptocurrencies are not on their own the only really evolution and innovation that's happening. We, of course, have the uptick in mobile money with the likes of M-Pesa and other systems. we're all, and especially these days, starting to interact with these payment system overlays, whether contactless Apple Pay at the point of sale. And I think another very, very strong driver here is what's happening in China with a full stack payment solutions, or you look at WeChat or Alipay, that are technology companies that are coming in to offer more of an experience, a full stack payment experience. But these last two is what I wanted to spend some time on and go on to some of the other drivers. So one, digital currency is following along a similar path alongside the innovation and the implementation that's happening within faster payments more broadly and real-time gross settlement systems. We've seen this, there's in Bank of England's and the work with faster payments, in India with NPCI, Target 2. Lots of different economies are looking to upgrade these faster payment networks, and especially here in the US, I'm just outside of New York. We have obviously the work with the clearinghouse and their real-time payments network, and what the Fed has announced is FedNow, that will be coming Fed later, I guess, in 2024. But no talk of digital currency is complete without mentioning stablecoins, and more specifically Libra. So Libra clearly has had really pushed the momentum for digital currency more broadly. And I think accelerating it. But it's interesting to note for Libra, which was introduced by Facebook and other companies as a concept last year, it's really important to look at Libra in two different ways. One is what has been the reaction to it from the central bank sector. I would argue that obviously central bank digital currencies were already a topic of interest. We started work in this space back in 2016 with Bank of Canada as one of the early central banks that we helped work on proofs of concept and research with. But clearly the introduction of what looked to be a potentially credible private sector digital currency that could be used in cross-border payments got people's attention. But it's important to think about what is the version of Libra 2.0 that has been announced recently. And through the versions from last year to this year, you can see the concept of Libra really evolve much more to be much more closely aligned to what Dinesh laid out earlier in his presentation, and what I think a lot of the folks in this space would describe a digital currency as. A few other aspects here. China is clearly driving this narrative with their DCEP work, and we expect that to only pick up pace. And lastly, we've had a bit of an overnight digital transformation. The last few speakers have talked about this, but we've moved to this overnight digital transformation, where there's in some cases a secular decline in cash, and in a COVID-19 world that we're living in now, there's been an overnight decline. But that's really just sort of the context setting. And I wanted to talk a little bit more specifically about looking at digital currencies, and specifically a digital currency that is represented on a blockchain network, blockchain system. What are some of the things at R3 that we're seeing out there from those that are considering adopting it, whether they're central banks or commercial banks or really businesses? And what are some of the things that we're seeing as critically important, especially as it relates to the definition of standards? So from a functional side, this is a common set of really requirements that we've seen. I don't want to talk about all of these in the time that I have. I just wanted to focus on one, which is integration with other ecosystems and smart payments networks and ecosystems. So this is quite important, and also I think it was echoed some of the previous talks, where one of the things that digital currencies can enable is to move the payments much more closely to either the asset or the business transaction that is taking place. And what we're seeing in the market at R3 is we're starting to see within some of these more asset-based networks within trade finance that are building and going live on Corda, which is our blockchain. There's a demand in these trade finance networks. There's a demand for real-time payments and increasingly for digital payments. And if these can be leveraged through digital currency, and even ideally through a very risk-free central bank digital currency. It's extremely important. But from a coupling these assets and payments together and allowing for really an asset evolution to happen alongside with the payment to be in fact triggered by the payment, in order for that to happen, there needs to be a common set of standards underneath, and one set of standards that we're obviously closely following is ISO 20022. I think it's typical with any set of standards. It's potentially going to be a bit delayed as it gets rolled out, but it has the potential to really unlock this loose but powerful coupling of the asset and payment together. Moving on to non-functional components, and there are quite a few. I just wanted to focus on a couple of how digital currencies can act in the real world. And this is around interoperability with other ledgers. And I think interoperability was a word that was already talked about, and I think we'll talk about it more. It's a very, very broad and loaded term. I wanted to kind of make it a little bit more narrow here. What we're seeing from the demand side, from a digital currency and digital payments perspective, is what are the ways that we can what are the ways that customers can participate in the innovation of a digital currency, but in a way that doesn't make them build a net new system or allows them to really put some training wheels on adopting that innovation. I think that's incredibly important. And I think one of the things that I would like to stress here is that one of the areas that standards can play a huge part is in effect, the last mile problem. We have a lot of focus on the supply side. How can I potentially issue a digital currency or a CBDC, whether it's wholesale or general purpose? But how it's used, and especially how it's used on the last mile, is extremely important. We're doing work with large incumbent providers to try and make this more of a reality. So we're working with SAP and Accenture on bringing central bank digital currency into domestic networks, where the participants can also use, in effect, their legacy systems, have that combination of the two. And working with MasterCard as well to take a look at these faster payment networks that are operating domestically. How can we stitch them together from a cross-border perspective? But bringing it back to the standards perspective, one example that I wanted to highlight, which I think is potentially a path that this group can look at, is in India with the United Payments Interface, or UPI. The adoption of UPI within India has led to not only more adoption, but more participants to be able to take part. Those are financial service providers, but also technology providers that come in and take part. And UPI is being considered to be adopted in other countries. And I think that's really allowed India to potentially, be a leader in this space. The last point I wanted to talk about is around reg and compliance, and maybe bringing it back a little bit more specifically to central bank digital currency. As I mentioned earlier at R3, we have done a fair bit of direct work with central banks, but importantly, not just central banks, commercial banks, other participants in these ecosystems, with Project Jasper, with Bank of Canada, Project Ubin with Monetary Authority of Singapore, the Inthanon projects with Bank of Thailand and HKMA, and currently working closely with the Riksbank in Sweden. And if you think about what Riksbank is trying to do, they're trying to get ahead of what they see as a secular decline of cash usage in their country, and they don't want to have parts of their economy left behind, whether they are either maybe some of the younger cohort that has a digital first way of interacting, and they want to be able to bring them into a risk minimized central bank currency perspective, or those essentially some of the older generations that are potentially being left behind by digital. So how can we tie these two together through blockchain systems and digital currency systems? And I think, finally, I want to commend the work of BIS. They released a new slate of papers last week, which was incredible as we move forward in this area. So I wanted to conclude with a couple of sort of maybe just takeaways or stories. We are starting to see a very strong demand for digital currency, and especially within the central bank digital currency space. This is a pull by businesses that are looking to be able to bring digital payments closer to the asset side of what they're doing. the opportunity is very large. The need for standards is there, but it's going to be a lot of work. And we feel that standards will emerge, much like I think the adoption will emerge in public-private partnerships. So often, in closing, we in the blockchain space, we like to think about making payment as easy as sending an email or sending a text. If you reflect back, email has moved to a standard of SMTP that was ratified in 1982. Text, SMS, that was helped put together by the GSM, that was defined in 1985. There was a lot of work between defining a standard and having it implemented. So we have a lot of work to be able to move to this more of this Internet of Money, Internet of Value, and making that a payment as easy as sending an email or a text and making it secure. But I do think that the demand is out there that we should start the work now. Thank you.
Todd McDonald of R3, thank you very much for sharing your perspective on digital currency on blockchain, as you call it, and the need for international standards and where we are as an industry today with quite a bit of real demand, and as well as the starting point of a number of standards initiatives. Thank you very much. I'd like now to invite our next speaker, who is Zik Kopik. Silo. Zik, you have 15 minutes, please.
Great, thank you so much. Let me go ahead and share my screen here. All right. So I trust everybody can see this. So first of all, I'd like to thank the ITU for convening this really important session. I'd like to also thank my fellow co-panelists. It's been really informative for me. Obviously, there's a lot of work to do, but there's also a lot of energy and excitement around this. So a quick brief introduction. My name is Ezekiel Kopik, or Zeke for short. Ezekiel can be tough sometimes. I am working on a open blockchain platform called Cello, which is the idea of that is to make financial service products available to anybody who has a smartphone. Before joining Cello, I was a former central banker for many years at the Federal Reserve Bank of New York. So the idea of central bank digital currency is one that is very near and dear to my heart. And it's one that I think has a tremendous amount of promise. But of course, for that promise to be fulfilled, one of the issues is interoperability, and that's what I'm going to focus my remarks on today. It's the topic that is gaining urgency within the CBDC universe. Also, we've already heard from Todd and from Larry as well on this important topic. So clearly, there's a lot of work around it. So one of the things in thinking about this, a recent study by the Official Monetary and Financial Institutions Forum, I think it was late last year, released a report on retail CBDC, where they surveyed a number of central bank representatives. And in the report, about 60% of those central bank respondents expressed a concern that interoperability would encumber progress on CBDC issuance. Fully 43% of them also suggested that they were really only focused on strictly the domestic CBDC use cases. And so the issue, as the report notes, is that a divergence in standards across countries could really limit CBDCs from reaching their full potential. So there are a lot of ways to think about interoperability. But I'm going to focus my remarks today on interoperability in the CBDC space as it relates to retail, and specifically as it relates to the tokenized version of CBDC. And so I want to touch upon this idea of building bridges between blockchains. And so first, in order for us to understand the importance of bridges, I think it's important to just quickly take a step back and look at sort of the evolution of Bitcoin and Ethereum, which are two of the biggest crypto assets out there. In fact, Bitcoin is the largest crypto asset with a market cap of about 175 billion, developed in 2009. Many of us are obviously familiar with the evolution of Bitcoin. And then about 6 years later, Ethereum came along. The Ethereum blockchain was created. And so although its market cap is a fraction of Bitcoin at only, well, not only, but at about 26 billion, one of the things about Ethereum was that it really revolutionized the crypto space. And specifically, it did that by allowing people this ability to create decentralized applications, or dApps, as some people will refer to them in the nomenclature. And the idea of this is that you can leverage this smart contract technology to really address the real life use cases. And I think that's where the power is these real life use cases that people have. And so what we're seeing, what's sort of been developing over time is this issue facing the industry is that many people, for example, who hold Bitcoin, there aren't a lot of dApps on the Bitcoin blockchain. And so they want to take advantage of these these decentralized applications on the Ethereum blockchain. For example, then that would allow them to utilize like savings applications or lending applications as two sort of broad examples. But however, Bitcoin and Ethereum, both operate on two very different and distinct blockchains. And so the idea is that, for a Bitcoin user to access a dApp on the Ethereum blockchain, she would need to access a bridge between the two chains. But of course, this is where things can get tricky. And so when you're bridging from one blockchain to another, there are essentially two options. There is sort of the trusted or the semi-trusted option and a trustless option. So in the trusted version, a user essentially exchanges her Bitcoin for tokens that can be used on Ethereum. These are often referred to as ERC20 tokens, which is basically a technical standard for token implementation on the Ethereum blockchain. So anyone using this option is sort of implicitly relying on or trusting a small group to verify that the tokens they receive are in fact valid. So for example, there's a project called WBTC, which stands for Wrapped Bitcoin. And in this system, you rely on a consortium of institutions performing different roles to essentially wrap the Bitcoin that you have for use on Ethereum. There's another project being developed called TBTC, which is working to allow people to use their Bitcoin in Ethereum dApps by using a group of randomly selected signers to safeguard this transaction. Now, in both instances, there is some level of trust that the tokens that you received are in fact backed by the Bitcoin for which it was exchanged. So the second option does not require the user to trust anyone. This is the trustless option. So in this version, the protocol will instead verify that the state of the chain to which it's connecting to ensure its accuracy and legitimacy of the transaction. So you can think, in this wholesale CBDC world, the trusted option may work because they're in this ecosystem, the participants are rather small. But when you think about a retail CBDC, especially a tokenized version that doesn't use accounts, many will likely want to prefer the trustless option. But there are issues associated now with the trustless option as well. Oops, sorry about that. And so specifically, one of these issues is the fact that blockchains have been growing steadily in size, making it harder and harder for resource-strained devices to do a full sync and thus verify the state of the chain. So as you can see in this chart, the Bitcoin blockchain has increased significantly in the past few years and is now more than 280 gigabytes of data. Excuse me. And the Ethereum blockchain is even larger and just at around 340 gigabytes. So if you wanted to create a bridge from Bitcoin to Ethereum, you would essentially have to recreate the Bitcoin blockchain on Ethereum, which effectively doubles the size of that chain to more than 600 gigabytes. And these smart contracts are resource constrained, right? And you're also using them perhaps on a mobile phone which is in itself also resource constrained. And the process can be expensive as well, which basically means that you simply can't do that much computation, nor can you store that much data. This means that it's effectively impossible to bridge from one chain to another using a full sync. The data requirement is simply too great. So, but it does appear though that the founder of Bitcoin, whoever that may be, contemplated this very issue. In the original Bitcoin white paper, there's a description of what's called the simple payment verification technique, describing how a light client can sync with the chain by downloading only the headers of a chain. And if you assume that there's no 51% attack scenario, the simple payment verification method would suggest then that the light client can verify that the latest header it's presented with is in fact part of the longest chain. Then the light client can then request transaction data from full nodes and use the latest header for verifying any Merkle proofs the full node sends with the data. But unfortunately, the amount of header data needed to sync in this fashion is still really large. For Bitcoin, it's about 50 megabytes, and for Ethereum, it's about 5 gigabytes. So you can imagine that's still a tremendous amount of data. So returning to our cautionary tale, so even using the simple payment verification method, there's simply too much data to create a trustless bridge between these two chains. So in fact, there was a project called BTC Relay, which tried to sync the Bitcoin chain on Ethereum, but the cost of maintaining this became prohibitively expensive. The last write to the BTC Relay smart contract was almost 2 years ago. And so the reason why I'm bringing all this up is because it's incredibly important and relevant for our discussion on central bank digital currencies. So as Bilal had mentioned at the very start of this, obviously many central banks are contemplating the issuance of CBDC. And as Bilal noted, that this is likely going to be done on a private network that may or may not utilize blockchain technology. But it's also probably likely that this private network that is created to issue CBDC is probably also not going to have the ecosystem to produce a significant amount of these decentralized applications that provide utility for many people. Certainly there can be some, obviously, but with a private network, people wouldn't sort of have the ability to then work on them and create these applications like they do in Ethereum or in other blockchain protocols. And so as with Bitcoin, users of this CBDC, whichever it is and whoever produces it, are also going to want a bridge between other public blockchains, between their private blockchain, which has their CBDC, to other public blockchains like Ethereum, where you can access these dApps. You can also easily imagine a scenario, where you want to build bridges between CBDCs of various countries. And you can certainly try and build a trusted bridge between CBDCs, and that might definitely work on the wholesale side, because again, there's a smaller group of trusted players. But when it comes to the retail side, there's probably limits to the amount of trust that exists, that citizens may have between countries, between central banks, etc. So it's likely going to be necessary to create this trustless bridge. But in order to create a trustless bridge that works on a resource-constrained device, central banks are going to need to ensure that the data necessary to verify their transactions is as light as possible. And so this is where I want to, so in order to solve this problem, the team working on Cello has developed an open source light client called Plumo. And that is something, so Larry had touched upon it himself. And the idea of this is when thinking about how do we create these bridges and how do we have data that, as light as possible, we looked at, some innovations around epoch-based syncing, BLS signature aggregation, and these snarks, which Larry had discussed before, to really reduce the amount of data necessary to verify the state of a blockchain and then create these bridges. Now, I'm definitely not the expert, and we don't have time to get into all the details, but I just wanted to note and sort of give you the information that the innovations that we've made in focusing around these types of technologies has allowed the Celo blockchain to be able to verify the state of the Celo blockchain. We've reduced that down to a single 500 byte proof. And so what that means is that our light client is 100,000 times lighter than Bitcoin and about 11 million times lighter than Ethereum, which also then means that building these bridges are possible. And so, in my concluding remarks, I just want to sort of say that, whether, you use these types of innovations or not, the idea is that, we need to start thinking about how we're going to reduce the amount of data necessary to create these bridges, because otherwise, it's very difficult to move from one to another, especially when we talk about financial inclusion and we talk about helping those people in remote parts of the world that may not have access to bank accounts, and so they may require a tokenized version. And they may require, access on their mobile phone. But again, if you're in a remote part of the world and, your data connectivity is already limited, we're going to need to think about solutions that reduce that data requirement. And so those solutions can be, around what we're doing at Celo and on Plumo, whether it's epoch-based syncing, BLS signature aggregation. Larry mentioned the snarks as well. It may be on something else entirely, but I think it's, as Todd mentioned, it's important and these things are going to take time. And so, we need to start having that conversation now. But with that, I thank you for the time and happy to address comments when they come up. But again, thank you very much.
Zach Kopik of Celo, thank you very much for sharing with us your thoughts on how to build bridges between blockchains, the various models, the trusted, the trustless, the public, the private. But very interesting to know that 300 gigabytes or thereabouts for the chains, and that's quite a significant amount of data, and as you mentioned, it's growing year over year. So thank you for sharing with us your thoughts on how to build the bridge between blockchains. Our next speaker is Jacques Francoeur. Jacques, you have 15 minutes, please. Go ahead. Jacques, if you can unmute and turn your camera on, that would be great.
All right, I think we're good. Well, good morning, good afternoon, good evening. I'll be talking about the challenges that we have as an ecosystem in protecting digital currencies. Now, that may mean totally decentralized currencies as cryptocurrencies, or purely centralized, or something in the middle. At this point, we want to take a common approach as much as possible to the IT infrastructure that supports these currencies, try to extract as much commonality under the whole platform, and then as you rise up the stack, you start introducing distinctions. But certainly making sure that we can adopt as much common approach will save us all time and money. Let's take a quick look at our today's report card in terms of the global state of protection. You have in 2018, $86 trillion economy. In 2019, 4.5 billion people out of 7.7, or 59% penetration of internet connected individuals. And all these reports are cited below, but it's the fourth greatest risk facing the world. So basically, you can look at the gold part as a target, 4.5 billion people, that's a lot of target. let's go see how we're protected by a document that ITU produces. You have 27% or 1.2 billion people who think they're protected. That's the upper part of the globe. And you have 73% or 3.3 billion people who are underprotected, with 45% with no protection. Those are the darker blues on the bottom, the darkest blue being the 45%. So now let's take a look at the money we're spending to achieve that so-called protection. Security spending is estimated to be $300 billion by 2023. So those 27%ers, the advanced world, who think they're protected, spend 80% of the budget, or $240 billion, protecting themselves. Not very well, if you ask me. The remaining 73%, or 3.3 billion people, spend a mere 20%, or 60 billion, to protect themselves. So this is clearly not sustainable. So security inclusion is, including those 73% of the people who are not protected, and this also kind of means that we need to start using security by design. So we clearly have a struggle to protect. And so what are we going to do in the Internet of Value, where we want this sort of value creation force to be strong and vibrant, value creation anywhere, consumed somewhere else? I think there's a need for a rethink, certainly in security, because we're not doing very well, and it's gotten so costly and complex. Now, because you have a value creation force, humankind will be that there will be a theft force or a risk force. You'll have value creation is threatened by value risk. Or say it the other way, value risk is threatened by value, or value risk threatens value creation. So I'm starting to bring up the notion of relationships. Because you have value and because you have risk, the people who own that value will want to see it preserved. So you have this value preservation force. And value creation is protected by value preservation. A dollar preserved is a dollar created. And then you may have some assurance forces that want to make sure that the value is being preserved. So you have value preservation is validated by value assurance, or again, reading it the reverse way, value assurance validates value preservation. So all we're saying here is this is it. Okay, it's not that much more complicated than that, which is kind of not totally true. Internet of Value ecosystem. So value creation anywhere, and especially from the edges, right? We don't want anybody to have to move to the centers where creation has traditionally occurred. We want to have creation anywhere and consumption anywhere else, right to the edges, right? So again, no need for mass movement to enable this. This is essentially a supply and demand relationship. And what we're looking at is what is going to be the exchange friction and loss, right? We talked about interoperability friction. The theft loss may result in some losses. So we have to start deciding what those levels will be. So, 1 second, sorry, all right. We're right here. Okay. So we're looking at an ecosystem. Well, we have to look at an ecosystem level. And as in any ecosystem, you're needing to have positive synergistic participants acting in an integrated way, in a cohesive way, but taking some attention or trying to pay some attention to some system level characteristics of the behavior of the ecosystem as we create and consume and transfer and transact. So financial inclusion is clearly the promise of enabling creation and consumption to occur anywhere, but there will be inherently some theft of that value. The threat space is growing, exponentially more sophisticated. But if you look at the standard laws and regulations in digital currencies, it's the Wild West. So unfortunately, we've lost a bit of trust in the system, and then we need to kind of rebuild that trust and not lose it again, if you will. So we have to make sure that we include security and that we improve the confidence, because a lack of confidence will impact consumption, right? And so supply demand, it doesn't really matter if you can create all you will if there's not a consumption on the other side. So it's essential that we start controlling or mastering risk and threats from a consistent common approach. And so what are the things, so one of the things I want to make sure you come away with here is that bad rap that security has, that's just this add-on thing that's complicated. But security, if you want a digital economy, I created value, I purchased value, we'll need to have some confidence in assurance to make sure that we can attribute ownership to the right person who either purchased it or created it. And then after that, we'll have issues of what was created and what was purchased. 1 second, there you go. So in addition to the I part, if you will, I created value, I purchased value, we'll then say, okay, you did, but what did you purchase or what did you create? And so you'll have the ubiquitous sort of use of all forms of cryptography for immutability, confidentiality, authenticity, proofs, attribution, distributed trust. So basically, at the end of the day, those security characteristics of identity and content assurance and many other aspects of security will collectively provide the confidence for people to say, I own value and I will transact, right? So assurance for trust, liability management, and warranties, which are essential for the ecosystem to operate. All right, so the need for standardization. So we're talking here performance and security specifications. So many performance specification characteristics were mentioned earlier, maintainability, scalability, resilience, many non-security things. But there's this process that we need to engage in as an ecosystem, from innovation, collaboration, the validation of the specifications, the issuance of security controls or controls in general, and then the market use of those controls. So right now, standard today, if we can get through the process of providing ITU with the input they need to produce global standards, everything will occur sooner. Standardization sooner, adoption sooner, value creation sooner, value consumption, which is basically the Internet of Value occurring sooner. So that's the objective, is how can we go through this traditionally very painful process and bring in the notion of hyper standardization. Now, Bilal, I hope you weren't standing, but the time to standardization, 10 years is too long. So we need to improve the confidence, reduce the time, reduce the cost, and the ROI of performing this work that was mentioned earlier as, in fact, very painful, very costly. And so we have definitely the need for expert collaboration. You can see here that we want to try to drive ecosystem-wide set of requirements, specifications, measurement metrics, methods, models and templates, maximize reuse. Now, we're all talking about different models and systems, but at least we need to try to drive commonality across the board right up front by design. Now we're talking time to validation. So the collaboration by experts to generate the specifications that only the experts can create is then handed over to a validation process where the outcome is standardized. So this is the beginning of trying to input better information into the standardization process like ATU, but I'm talking about standardized, common, consistent, comparable specifications, metrics, and models. So what is key is the validation process will engage this approach of trying to be common, consistent, comparable as possible. And the output of the validation process are standardized models, metrics, methods that will ensure repeatable with high confidence performance and protection, assessments and benchmarking across the ecosystem. That is what we're trying to do. And at this point, this would go into ITU for its traditional standard producing process. But what we're trying to do is really improve the input side of the process. So I'm going to sort of say here, kind of a model here, the need for top tier, right? You can't be like Equifax and be negligent in terms of your standard of care, especially if you're a trusted provider. right? So if you're a trusted solution provider, your standard of care will be a little higher. So this is kind of a strategy for the fintech sector that has been tagged with the inability to provide the amount of security required. So the key thing here is to keep it small, keep it separate, keep it dynamic, expand on demand, contract immediately. That maintains a small attack surface. If you outsource to a top tier 1 cloud provider who are actually innovating so fast that there's no other way to keep up, at the end of the day, you will have access to advanced IT capabilities like expand on demand and contract the size of your footprint, your attack footprint, and you'll get some secure by design capabilities, right? So if you can't do security, if you can't do IT, get out of the business is what that is saying. Now, sorry, 1 second. Oops. So basically, you then have your object that you need to protect. Your, limited scope, limited, don't try to integrate it with your entire other IT systems, because then the scope of compliance will increase dramatically. But you want to be able to use and protect using a custom complete internal control framework. And that's kind of saying that external frameworks aren't necessarily complete. They were created well before you exist or you knew of the target. So you have to kind of go through the target to determine what are the controls that are specific to what I'm building and that are complete, i.e. that I've covered all possible controls that I need to address. So the need for a common reference to start with, right? So here you have an ecosystem of all kinds of value processes. That could be a digital currency issuance, transaction, transfer, and it is the use case that defines the purpose and context, and therefore the scope of applicable standards and laws. So once you pick a value process like issuance, then you have a relationship with a bunch of value assets, IT assets, that enable that value process. So by going through all your value assets, you end up getting what we call the value asset profile, which are basically all the assets involved in enabling that value process. So great. In other words, now now we have something, whatever that is, that all of us can talk about on a common basis, right? So here it's not interoperability. In this case, it's domain interoperability, so that when governance and policy talks, who in essence design the model, well, that's going to drive architecture and use case, which will then drive privacy, security, and assurance. We can't fulfill those last things until we know what we're talking about. So common reference, and this is about actually using a target, something that we define right off the bat. So the next thing then is that framework that we saw earlier. So for example, if we take one value process, a digital currency issuance, now we can get specific. Now we know exactly what the currency, what the value assets are that enable that. And then it becomes your target. And there, so I'm a security guy. I'm about targets. So my value asset profile becomes an attack surface profile. But again, the model can be used by other people for other purposes in other domains of conversation. But what is fundamentally important is that we're talking about the same thing. Mm-hmm. And I transfer the target into an attack surface. And then what I then do is I use all this good stuff that's out there, all this amazing knowledge that the standards, regulations, certifications, and I use that as a process of systematically going through and making sure I'm protecting every value asset of every value asset in a digital currency issuance process. All right. So now the next thing here, I'm not trying you to get to understand what it is, but what was really interesting, it was mentioned earlier, too much granularity is, it's heavy, not enough is too light. So we need nomenclature. All other domains of science have nomenclature, but security doesn't have that. So you can see here how I can take a digital currency system and go down 5 levels and get to a component vulnerability, because that's what I have to protect. That's where the action is happening. And then what happens is that you take that and you make a copy of the middle, and you color one red and the other one blue, and then you put a nomenclature distinction on each side. So this is a copy of the middle, and you see the -R and the -P. So now I can start understanding of whether I'm talking about a threat to, a countermeasure to. But right now, and so what we do here is we take now this, sorry, Bill, but, and then we introduce the notion of a stack, right? So application service protocol network all the way down to physical. And so you do that, and you end up getting the table that we just saw, but with a stack distinction. So you can talk about an application threat class or a protocol component threat. All right, so if we take that one row right there, minus 5.3, and we, and then we, at this point, we can now put threat data. Okay, so all the way up to this point, that table on the upper right had no notions of actual threats or countermeasures. It was a pure classification system. But you can see here that, you can see, I'm going to zoom into that, but basically you can see consensus mechanism threats, right? There's a number of them, but you can see that the nomenclature to the right of that, you know, can have a -51A, a -TMA for time manipulation attack, and so on. And all this great work is in the X1401 standard. So Bilal, I'm hurrying. So remember the need to rethink. So basically, it's not a rethink. It's almost like an upgrade in thinking about security to a relational model. So this work here has also been published in a technical report at ITU Study Group 17. But this, you saw this before, right? So you have one value process. It's enabled by a number of value assets. That value asset will be threatened by a threat vector. And you can see the relationships to threat vector threatens value asset. Now this left side, the gold versus the red, that's a business impact analysis. And now we're going over into the other side, and what is the internal commitment or the internal control to protect that value asset, given what it's doing in the value process and how it can be threatened. And this policy protects value asset is the financial commitment part. And then once you've made your financial commitment how to protect your asset, then you sit down with the security people and what are the people, processes, and technology that enable that internal control in such a way that you can prove that you met the requirements of an external control automatically, if you will. So this is now a representation, a relational model that interestingly applies to a single vulnerability of one value asset, right? This expression is unique to one vulnerability of one value asset. But basically you can generate hundreds of these or thousands and institutionalize the data. Now, all this great work has also been included in some good ITU work. In fact, the deliverables of the focus group published this work, Protection Assurance for Digital Currencies. And it's also in part in the X1401. So I'm trying to accelerate things here. Okay, so basically, in conclusion, better standardization, input, better output, using common, consistent, comparable, get standardized, good stuff. So basically, the objective is to remove the sort of basis of confusion or friction by design ahead of time. So in conclusion, you can realize this, that current approaches to security are not working. And oops, I have that all the time. Current approaches are not working. I'll just do this, get them all. You know, it's time for interoperable by design, right? Because the normal ways that we've done this is that we kind of don't worry about this stuff, and then we end up 10 years later, 5 years later, and we're trying to actually communicate with each other. So, you know, accept this, that digital currency use cases will need a trust standard. Now, I think I heard from Dinesh that extremely good security. So good, I've noted that down, extremely good security. So I'm asking the audience here to participate in the discussion and development of these standards, and that will give you the ability to influence and shape the future. Thank you very much.
Good. Excellent. Jacques, thank you very much for sharing with us the struggle to protect, as you call it, and to protect the value, and the need for a common reference, and especially your reference to the X1401 as a first step towards a journey to put in place the security standards for digital fiat currency. Thank you, Jack.
Thank you very much.
That ends our presentation section of today. Before we move into the questions and answers, we have an announcement to make. And I'd like for us to do that now while we have most of our participants online within the time that was announced. So I have the great pleasure to announce that ITU and Stanford University will be launching the Digital Currency Global Initiative to continue the momentum in ecosystem dialogue and the research accomplishments by the focus group on digital currency, including digital fiat currency, on pilot implementations, applications, and the development of specifications for technical standards that will foster adoption, universal access, and financial inclusion. The main objectives are to continue research on technical architecture, security best practices, and assurance level, operational implication of central bank digital currency, policy decisions, interoperability, technology trends in digital currency, and use cases. Develop a set of metrics by which to evaluate, validate, and benchmark the various characteristics of digital currency technologies against the requirements set by various ecosystem stakeholders. Identify areas for standardization to enable implementation of digital currency in the shortest time possible, and host a global annual conference to enhance relationships and share information on best practices, technical standards, and lessons learned on implementation. The outcomes of the Digital Currency Global Initiative will contribute towards the United Nations Sustainable Development Goal number 1, no poverty, number 9, industry innovation infrastructure, and number 10, reduced inequalities. The activities of the initiative will fall under 3 pillars. The standardization pillar, intended to focus on the development of technical requirements for architecture. Innovative use pillar is intended to focus on compiling use cases on digital currency pilot implementations and developing technical metrics. And the engagement pillar, which is intended to focus on engaging a diverse set of stakeholders in the work of the initiative. I'm pleased to announce that the Digital Currency Global Initiative launch and kickoff meeting of its 3 working groups will take place on the 22nd and 23rd of July at 3:30 to 6 p.m. Central European time. We would very much like you to join us. So 22nd, 23rd of July. Please join us, join our mailing list to receive the meeting invites and more information about the forthcoming events for the initiative. A call for experts will also be launched, inviting experts and researchers in digital currency from around the world to join and contribute to the mission of the Digital Currency Global Initiative. I do hope our panelists will also join us in the work of the Digital Currency Global Initiative. I'd like now to reintroduce you to the Executive Director of the Stanford Future Digital Currency Program for some remarks before we move on to the rest of the session. Larry, you have the floor for some remarks about the initiative, please.
Oh, great. Thank you. Thank you, Bilal. First of all, thank you very much for allowing Stanford to participate in this program. I also want to especially thank BJ for all the hard work that he put into developing this relationship. It took a little bit of work because of the complexities of the convergence of 2 large bureaucracies. I'll admit that. However, the reception that we've received so far within the community here in Silicon Valley has been very, very positive. Again, echoing some of the remarks that Ezekiel made, there is a demand at this point for standards around digital assets as well as digital currency. The result of kind of just the partnership and of collaboration that we've formed has generated numerous calls from other central banks for help and advice. One of the things I want to emphasize is that Stanford would remain a very neutral party, and they will also act as a very independent party, so that we are really here to in part help to validate the various central bank digital currency models and digital currency models that exist around the world. We see ourselves again as a unifying force. We don't see ourselves as in any other format, and I really want to emphasize that. So when we work with companies, we want to work with companies around the world again, and part of our function again is to validate models. And in validating those models, we will learn the best practices that those models are using, and then share that information with the ITU so that we can continuously, in an iterative process, improve the standards. Okay, and as Dinesh said, and I think everyone on this call is also recognized, the standards are going to constantly change as the technology changes. And where we are is in a very, very exciting point, and I'll just conclude by saying this, is that we're at the convergence of technology with the use of money, and the ITU is playing a very, very important role. And I thank you, Bilal, for your efforts sincerely, because we know, at least at Stanford and other institutions that I've talked to, that without the help of the ITU and without the help of international cooperation, we're not going to have this seamless, very efficient financial structure that we need around the world. We don't want to build this Tower of Babel. We have enough Babel. So thank you so much, Bilal. I've gained a tremendous amount of respect for the ITU. I've gained a tremendous amount of respect for you as well as your members. I also want to thank Jacques, because he's actually worked very tirelessly for 3 years and helping to form this partnership. I've worked for 2, but Jacques has selflessly worked in creating some of the standards that he's looking forward to seeing adopted.
Thank you.
For security. Thank you again.
Thank you very much, Larry. Welcome to Stanford University as an academic member of the ITU, and very pleased to partner with you to work on this initiative. Thank you very much for helping set it up. And also, as you mentioned, thanks to Vijay in the ITU, who has been an instrumental member of the team to put all of this and connect the dots and make this initiative possible. With that, I'd like to close our panel by having one question, last question to each of the panelists, which is the following. In what areas do you think that technical standards are required in digital currency applications? So I'd like to invite all the panelists to turn on their cameras, try to answer this question on technical standards that are required in the digital currency application. I'm cognizant of the time being a bit tight. Most of the other questions by the audience have been addressed in the Q&A chat. So I'd like to please hand you the floor to try to answer that question. I'll start with Dinesh. Please go ahead.
Thank you, Bilal. And I'll just say congratulations on forming the initiative with Stanford and ITU. So we look forward to seeing some really interesting work actually from that initiative. So your question is kind of a tricky one actually, because we're very early in this journey here, and as I think a couple of people have mentioned, there's still some work to do in deciding just where do we focus on. But if I were to just say very broadly, perhaps one thing I worry about is having two big kind of overarching sort of standardization effort. So perhaps one way to approach this is to think about, if you think about a system architecture for CBDC, and you decompose it, right? So it's going to decompose into a set of elements that may be actually fairly common, in fact, across CBDC and DFC. And perhaps it's at that point we start identifying which are the particular components which should really best benefit from a standards effort. So something like, close to your heart, something like an X509 standard could be really a good indicator, right? That there's this particular piece of work where you can really see strong benefits in standardization, right? So I think that's probably the key thing to identify. So I don't think there's a list I have of where to focus on. I mean, I mentioned things like interoperability, for example. So that automatically leads to something like standardization of an API or in some form or other. We know that identity is quite a hairy problem, and but there are other initiatives working on that, certainly nationally, but even globally now. And I wonder at one level if standards can be boiled down in some areas to really a set of best practices or even toolkit, right? So we have different ways of achieving privacy. There are all these privacy preserving mechanisms that a couple of people have mentioned, like zero knowledge proofs and a multi-party computation and so on. So perhaps rather than a single standard, we could imagine a set of tools that could be used, which are standardized for different jurisdictions in different ways. I'll stop there.
Great, thank you. Thank you very much, Dinesh. I see that Larry is taking good notes of your suggestions, and this for sure could be an area of work of the Digital Currency Global Initiative. We very much would welcome you, Dinesh, to join that effort. I'd like now to move to Zik and ask you the same question, please.
Great, thank you. Yeah, and congratulations again to the partnership between Stanford and ITU. This is going to be a great initiative. So happy to be invited. I mean, I think, for us, the way we're looking at it, and the way we've kind of historically have always done it is to really focus on the least common denominator. And so, we've always been a mobile first protocol and application because, quite frankly, there's a lot of people, as people mentioned before on this panel, there's a lot of unbanked, but surprisingly, even for people who are unbanked, whether they choose to be or whether they choose not to be, because there's just no infrastructure for banks, most of them have mobile phones. So I believe the last Ericsson report suggested there were something like 6 to 7 billion mobile phones that had an active subscription. And so clearly there's a lot of people that do have access. But I think that, in some of the things we have to worry about as far as standards go is to make sure that, the systems that we're designing, we're not designing them for 5G with, ultra high speed Wi-Fi, because that really does limit the amount of people that can take part in that. And so we need to really, focus on, the sort of least common denominator and make sure that our applications are using as little data as possible. And then that will also then help with this interoperability of bridging between chains. And so I think that's definitely where we're focused our efforts on, to make sure we can really target those around the world that really need the help.
Great, thank you. Thank you very much. Now I'd like to move to Todd, and also thank you, Todd, for answering many of the questions on the Q&A chat. That helps us to save a bit of time. This is the beauty of virtual meetings. We can multitask. Todd, you have the floor.
That's right. I always do what I'm told, and I'm happy to pitch in and answer the questions. So a brief one on standards, technical standards. So if you look at the work that Riksbank is doing and other central banks, but also in the private sector, kind of echoing what Zeke was saying, when we move to a digital currency world and potentially even the digital identity credentialed world, the standards are going to need to be here, right? In the digital wallets, to be able to interact with these digital goods, whether they're something that represents my identity, something that represents what's in my bank account. And I think that's where the key standards will need to be on the technical side. And I guess the only other thing I'll say is that it most likely will be emergent versus top down. So maybe this is a call to action to the central bankers out there, I think those that move more briskly to bring this to reality are the ones that be able to set the pace on standards.
Absolutely. Thank you very much, Todd. Jacques, you
yes,
spoke about some standards. Go ahead.
I'd like to just make a comment on models and modularity. So what is frightening, if you will, is the complexity ahead of us, right? Of all the different variations, and the fact that I remember in the last 20 years in Silicon Valley how we progressed through those 20 years. It was evolution, haphazard, nothing. So from here we want to create models with relationships to other things and make those model relationships available for consumption. So going beyond just a document of a standard of which there could be 5,000 documents relating to a system, how is a human even going to travel through that knowledge, reconcile, where they have to go with their specific interests? And so to kind of, work with the ecosystem to generate the information, but to link it up together to the things it relates to allow everyone to, if you're non-security, you're still talking about the same, I call it a target, but you're still talking about the same object. So the industry has had challenges in the past for everyone in the ecosystem to talk about the same thing and for that thing to be defined. So that's normally not done. And so we're going to try to do it this time.
Super. Thank you, Jacques. I'd like to ask Larry the same question about standards. I think you took note also of the others' interventions. But there is one question as well, Larry, if you can address it from the Q&A chat, that was about whether the COVID-19 has encouraged digital financial inclusion in the US. Perhaps if you could address that first and then address the standards question. Thank you, Larry.
Sure. The honest answer is there was an attempt to increase financial inclusion through some of the bills that I had mentioned in the two prior COVID bills. There was a request that Treasury come up with a means of delivering the money in some other fashion than through checks, particularly again to the unbanked. That portion of the bill was taken out. The subsequent action that was taken was a letter by about a dozen members of Congress to the Federal Reserve, asking them to look into means of delivering money faster to needy people within the United States. I will, and I'm not here to toot my horn, but I did write an article with Bob Hockett, who's not on the phone. It was an op-ed, just so people know, that suggested that we use a treasury system. It's called Treasury Direct. Most people in the United States don't know about it, but American citizens, even citizens around the world, can buy U.S. treasuries directly from the U.S. Department of Treasury. They just can get on the website. So our proposal was to kind of reverse the Treasury Direct system and have people sign up for Treasury Direct, and instead of money going from the individual to Treasury, the money go from the Treasury to the individual. That was never adopted. The reason why it wasn't adopted is because Treasury is resource constrained at this time. As far as my recommendations as technical standards, I'm going to kind of echo a little bit what Jacques says. Now, most people on the phone may not know this, but I'm a former regulator. I worked at the Federal Reserve for 10 years writing regulations. What I found was that after writing probably 1,000 pages of regulations, I realized that we need a better system. And so I think Jacques is suggesting something that might be helpful here, which is we need some form of methodology or some form of models that actually create not only help create the standards, but also our means of compliance for people to check their systems to make sure that they comply with the standards that we set. We're at a point where it's virtually impossible to write standards and then have people who are building or writing code to actually compare their code to the actual written standards. In the United States, we have a huge problem because the regulators require that all code actually be described in the English language, and the reason why they do that is because the regulators don't know how to code, right? So they can't read code, so they don't know if code is in compliance or not. It's a huge, massive task. So what I'm a big proponent of is something along the lines of what Jacques is saying is once we set standards, how can we do it in a way that we can put it into models that, again, help check any CBDC model or any digital currency model? And the last thing I'll say is definitions are critical. I mean, we need to have a common language. We come from different disciplines, whether we're lawyers, whether we're systems engineers, architects, or coders. And I've found in so many instances here in Silicon Valley, after talking to hundreds of people, that we're often not talking about the same thing, even though we think we are. And that's a huge problem. So I'm hoping with our efforts at the ITU, we will come up with a common language that will be the basis for the beginnings of our standards.
Yes, indeed. Thank you very much, Larry. A lot of the good standards start by having a common glossary of terms, definitions.
Yeah.
And then we go from there. So that's certainly something we can build on. Thank you very much to you. Thanks to all the panelists. Thank you to all the participants. I think we had sometimes about 140 or so online active participants today. I wish to invite you all to our next episode, which will be tomorrow, 30th of June. It will be on the topic of handling digital finance crimes and scams during COVID-19. And with that, I'd like to thank you again for your participation, to our panelists for your time and good insights in today's session. A reminder of the launch of the global initiative. I wish to invite you all to join us in the initiative, which will have its first meeting in July. Have a good night, good day, and we'll see you tomorrow. Bye for now.
Bye.